In 2018, Fidelity shocked the world and became the first brokerage to offer zero-fee index funds, and that's right, no fees at all to invest in an index fund. To some, this would be a no-brainer go-to option, but is there a catch and is it actually worth it? A company giving out free products to their customers, why not take advantage of it? But with 4 zero-fee index funds that they offer, Fidelity now has roughly $24 billion in assets under management from these funds, and it definitely is on the uptrend. With that being said, what exactly are Fidelity Zero Index Funds? For starters, when you have a list of securities like stocks and you have a bunch of them gathered into one investment that you can purchase all at once, this is called a fund. And when you have a fund, in order to make that an index fund, you have to track an underlying index. Trust me, this will all make sense shortly. So there are companies called index providers that create indexes, and some of the most popular index providers are the Standard & Poor's S&P, Dow Jones Industrial Average, DJIA, and the list goes on. To show how this works, let's look at the Fidelity 500 Index Fund, ticker symbol FXAIX, and this fund is known to track the S&P 500 index, which means it tracks 500 of the largest companies traded on the US stock exchanges, and it comes at a 0.015% annual fee to own. This means that if you were investing $10,000, you would be paying the price of a pack of gum every year in fees. So is an extra pack of gum every year the reason you're watching this video? Now, the reason that index funds have a fee for you to own the fund, which is also known as the expense ratio, is because the brokerage firm has to pay a licensing fee to the index provider. For this case, that's the S&P, and that is in order to track their index. So why does this even matter? The Fidelity Zero Index Funds were created with a sole purpose to charge no fees at all when you own them. And how do they afford to do this if they have to pay index providers? Well, they simply say, buy index providers and then create their own indexes. So currently there is 4 zero-fee index funds that Fidelity offers, and there are no bond funds. These are all stock market funds. Now, to better explain what exactly these index funds are, here's a quick example about the Fidelity Zero Large Cap Index Fund, ticker symbol FNILX. This fund tracks the Fidelity US Large Cap Index, but this says the index is designed to reflect the performance of the US large cap equity market, and below it even says limited to the top 500 companies. And that right there is their way of trying to mimic the S&P 500 without actually using the S&P 500. Isn't that just a great business model? Now, for those curious, I will be discussing in much more detail later in this video each of the zero fee funds that Fidelity offers, so stay tuned and don't forget to subscribe to the channel. But now that you know what Fidelity zero fee index funds are and how they operate, let's talk about why Fidelity created them. The first reason why Fidelity created these index funds is what is known as a loss leader strategy. This is a marketing strategy that companies use by giving out products or services at a much more attractive price, for this case free, in order to attract customers into their ecosystem and potentially buy other products or services. A popular example used for this is buying milk. To get it, you have to go to the back of the store. And what the company hopes is that by the time you get to the cashier, you have more than just milk in your hands. And voila, business is booming. For the case of Fidelity, their incentive to offering these zero-fee funds is to grow their customers and potentially get them to purchase more expensive funds, get a financial advisor, life insurance, etc. Now, not every customer is going to make Fidelity much more money from their other revenue sources, but just a small percentage could go a long way. Now, an important point to note is that these index funds can only be traded on the Fidelity platform, and they cannot be transferred to other brokerages. So if you're one that's seen my other Fidelity videos, which I will leave a pop-up here and link in the description below to my entire Fidelity playlist for you, but if you have an account already on Fidelity, this is not a serious issue, but that is as long as you plan to stay on Fidelity. So these zero-fee index funds benefit Fidelity greatly because it encourages new customers to try out their platform and get these zero-fee index funds, and it also makes it harder for those that are on the platform to switch, because if they want to transfer over, they need to sell all of their investment. That will incur taxes unless you're in a tax-deferred account. A good question for those that are not on Fidelity is whether or not it's worth it to convert from your brokerage account right now to Fidelity, which I will discuss this at the end of the video. With that being said, let's now go over a detailed breakdown of each of these zero-fee funds and compare them to their regular fee-based funds. The first one being the Fidelity Zero Large Cap Index Fund, ticker symbol FNILX. that tracks its own Fidelity US Large Cap Index and seeks to provide investment results that correspond to the total return of a broad range of large cap US companies. This index only contains companies with a market cap of $10 billion or more and is known to be a float adjusted market cap weighted index, which means that the companies in this index are given value and rank based on their number of shares and value outstanding in the market. So the Fidelity Zero Large Cap Index Fund is known to be closest in similarity to the S&P 500 index, seen as FXAIX. Now the Zero Fee Fund has 510 holdings, where the Fidelity 500 has 506. And the reason these indexes have more than 500 holdings is because some of the companies actually have multiple share classes. Now the Fidelity 500 has a 0.015% expense ratio, which is extremely small, but the Zero Fee is obviously going to win this. As you can see, its top 10 holdings for the Zero Fee Fund cover 25.08% of the portfolio, and you can see each one and how they compare to the regular fee-based fund that has 25.51% of its portfolio from its top 10 holdings. With that being said, let's talk about the turnover ratio, which is a unit that measures how much the fund is changing its positions throughout the year. A rule of thumb for this is that the higher the turnover ratio, the more likely it is going to cost you, since it means more positions in the fund have been sold and are going to trigger capital gains. So unless you're in a tax-deferred account where it doesn't matter, you're going to want a lower turnover ratio. For the Zero Fee Fund FNILX, the turnover ratio is 3%, where the Fidelity 500 is 2%. And that's not too significant. The investing style for the Zero Fee Index funds is relatively similar to the Fidelity 500, as it is targeted to be large cap blend between value and a bit more towards growth. Using another source called Portfolio Visualizer, if you started with $10,000 when it was created in 2018, that you would have made an additional $51 from investing in the Fidelity 500, the regular fee-based index fund, instead of the Zero Fee Fund. Another data point to look at is the compound annual growth rate, CAGR, and this shows how well the fund grows year over year, which includes the expenses from the fee-based funds. For this case, the Fidelity 500 beats it by 0.08%, and adding on to that is the standard deviation, which for the Zero Fee Fund is larger and means that there is more volatility for the fund. As you can see, the best year's performance was also higher, and the max drawdown was also the worst. And here you can see the equity sectors in the fund and how they are relatively similar, with their highest sector in the Zero Fund being technology at 24.94%, and the Fidelity 500 being technology as well at 23.87%, all roughly similar. With that being said, let's move on to discuss Fidelity Zero Total Market Index Fund, ticker symbol FZROX. This fund tracks its own Fidelity US Total Investable Market Index that is market cap weighted and seeks to provide investment results that correspond to the total return of a broad range of small, mid, and large cap US stocks. As the Zero Large Cap Fund was limited to 500 companies in the fund, this Zero Total Market Fund is limited to 3,000 companies. The Fidelity Zero Total Market Index is closest in comparison to the Dow Jones US Total Stock Market Index, seen on Fidelity as the Fidelity Total Market Index Fund, FSKAX. Now FZROX has 2,797 holdings, where the regular fee-based fund has 3,974. Now the regular fee-based fund also has a 0.015% expense ratio, which is dirt cheap, but not compared to the Zero Fee Fund. As you can see, the top 10 holdings for the Zero Fund cover 21.58% of the portfolio, and the regular fee-based fund has 21.45% of its portfolio from its top 10 holdings. The turnover ratio for the Zero Fee Fund is 3%, while the regular fee-based fund is 1%. The investment styles for both are relatively similar, and looking into the returns, a $10,000 investment since its inception would have outperformed the regular fee-based index fund by $106. Taking this into further perspective, its compound annual growth rate was 8.96% versus the regular fee fund being 8.79%, and the standard deviation was extremely close as well. Now the equity sectors in the fund are relatively similar, with the highest sector in the Zero Fund being technology at 23.29% and the regular fee-based fund being 23.35%. Again, all of the data is extremely close. But wait, because now we've got this one that's interesting, and that is the Fidelity Zero Extended Market Index Fund, ticker symbol FZIPX. This fund tracks its own Fidelity US Extended Investable Market Index that is market cap weighted and seeks to provide investment results that correspond to the total return of a broad range of mid to small cap US companies. This zero fee fund is stated to be a subset to the Fidelity US Total Investable Market Index, but excludes the 500 largest companies, and then it's limited to 2,500 companies thereafter. Now, the Fidelity Zero Extended Market Index is seen to be closest to the Dow Jones US Completion Total Stock Market Index, which is on Fidelity as the Fidelity Extended Market Index, FSMAX. Now, this is where things change, so pay attention because they are not exactly similar. The zero fee fund has 2,287 holdings, where the regular fee-based fund has 3,680. Now, the regular fee-based fund has a 0.035% expense ratio compared to 0. And as you can see, the top 10 holdings for the zero fee fund cover 2.97% of the portfolio, and the regular fee-based fund has 7.51% of its portfolio from the top 10 holdings. The turnover ratio for the zero fee fund is 16%, while the regular fee-based fund is 12%. And the investment style for the zero fee fund is weighted towards small to mid value, where the regular fee-based fund is small to mid growth. Looking into the returns, a $10,000 investment since its inception would have outperformed the regular fee-based fund by $436. And looking even further into that, its compound annual growth rate was 5.15% compared to the regular fee fund being 4.37%. And looking at the standard deviation, it is 0.5 percentage off. Now, the equity sectors in the fund are relatively similar, with the highest sector in the zero fee fund being industrials at 16.72%, and the regular fee-based fund being technology at 20.56%. Now, that's a pretty big difference. With that being said, the last one that Fidelity offers is the Fidelity Zero International Market Index Fund, ticker symbol FZILX. This fund tracks its own Fidelity Global Excluding US Index that is market cap weighted and seeks to provide investment results that correspond to the total return of foreign developed and emerging stocks. This zero fee fund is structured to select the top 90% of stocks by market cap within each country. And this fund is closest in comparison to the MSCI All Country World Index excluding USA Investable Market Index, seen on Fidelity as the Fidelity Total International Index Fund, FTIHX. The zero fee fund has 2,400 holdings, where the regular fee-based fund has 5,079. That is a massive difference. Now, the regular fee-based fund has a 0.06 expense ratio compared to 0, and as you can see, the top 10 holdings for the zero fund cover 9.72% of the portfolio, and the regular fee-based fund has 9.29% of its portfolio from its top 10 holdings, which many of these top companies are similar. It's just the fee-based fund has many more holdings, which to me is good. The turnover ratio for the zero fund is 6%, while the regular fee-based fund is 3%. The investment style for both the funds seems to be roughly similar, with a large blend aimed toward value. And looking into the returns, a $10,000 investment since its inception would have outperformed the regular fee-based fund by $152. Taking into further perspective, the compound annual growth rate being 3.56% versus the regular fee fund being 3.27%, with the standard deviation being similar. The equity sectors in the fund are relatively similar as well, with the highest sector in the zero fund being financial services at 20.66% and the regular fee-based fund being 19.63%. So now that you know what each of the zero fee funds are and how they compare to the regular fee-based funds, let's now talk about whether or not these are worth it for you. For starters, majority of these funds contain way less holdings than the regular fee-based funds. Now, as an overall, this means that there's less exposure, and theoretically it could contain more risk. In addition to that, every zero fee fund has a higher turnover ratio, which is a bad thing because it is going to trigger more capital gains. What does that mean? More taxes. And then there's the option of whether you would prefer Fidelity to create their own indexes or if a third-party provider is the proper approach for this. And although it's been a few years, these funds are still in a somewhat new phase, but they are proving to have strong results so far. But as far as if it's worth it or not to be getting these zero fee funds, if you are not on Fidelity already, let's say you're on Vanguard and you're switching over just to get into these funds, I would say that's not worth it at all. I don't recommend that, especially if you're in a taxable account. But the truth is, these funds are so close in performance that it makes it difficult to say whether or not it's better or worse. The biggest factor for all of this is your own opinion on the differences. For me, I personally do not invest into any of these zero fee funds yet. I might in the future, but I am happy that the only significant difference, at least to me, is the exposure to many holdings. But because you stayed to the end of this video, I'm going to be completely honest with you. I really hope you smash that like button and subscribe to the channel, because here is an order of what I believe should be best two worst for these funds if you are planning to purchase them. Let me know your thoughts about this in the comment section below. So the first one that is my favorite one is the Fidelity Zero Total Market Index Fund, FZROX. I say this because it has seen strong results as discussed earlier, but it also contains all the holdings from the second one that I believe should be on this list, and that is the Fidelity Large Cap Index Fund, FNILX. And just a reminder, be aware of overlap when you invest into these funds. The third one would be the Zero International Index Fund, FZILX, and then the fourth would be the Extended Market Index Fund, FZIPX. With that being said, thank you all so much for watching. Don't forget to check out my channel and hit that subscribe button for more future Money Talk content.